Thank you for coming. My name is Jeff Wilson, and a little over 20 years ago, I set up a little funds management group called Wilson Asset Management. Thank you all for being on the journey with me and with us. It's good to have partners that allow myself and everyone else that works at Wilson Asset Management to do what we enjoy doing, and that's investing in the stock market. In terms of the presentation today, I'll be giving you the introduction, and what I probably need is a clicker so I can move the slides. Thank you. Probably when you came here this morning, you thought to yourself, hey, this is a bit over the top. And that's exactly what I thought. And as I have Scottish blood, and one of the things is, well, I suppose, and that allows me to be a value investor, and also I'm a value investor. And one thing that frustrates my wife is whenever we're going on a holiday, I'm always trying to get a good deal. And she's saying, look, yeah, anyway, why don't you just pay the price? Because we all want to buy $1 for 50 cents. And when we come to a room like this, a beautiful room, the first thing I think of, oh, this must be the top of the market. Now, the reason we're here today is we actually, we normally go to another location. Unfortunately, we couldn't fit everyone in. The cost here, it is 210% more than the other location, which must frustrate you all. One benefit, and myself, one benefit is the bags that you selected outside only cost us $1.52, which was significantly lower than the bags we gave away 2 years ago. And the bags you got today are the bags that we printed last year that were left over. So don't feel bad. A couple of things from a housekeeping perspective. I just want you to, if we just flip over to that's the disclaimer. So if you can read that, then you can't sue us. Thank you. So is the end near? I mean, 6 months ago or 12 months ago, I would have been talking about where we are it's been a very mature bull market. In the US, it's the third longest bull market ever. So we're in the mature stage of the bull market, and we must be getting close to the end. Recently, I've been to the US. I came back last Tuesday. I went to the Sohn conference, and also it's the second year in a row I went to hear Warren Buffett. And on the Friday before Buffett's presentation, which was 2 weeks ago on Saturday, a number of people have conferences. And the conference I went to, they had a professor, 80-year-old professor for Columbia University, who is an expert in value investing. I mean, one comment he did make, and that was that the great thing about behavioural finance and human beings is they provide all the opportunities for you when you invest in the market. And why is that? Because they want to buy the pretty stocks, the stocks that everyone likes. And he said, you've got to focus on what is ugly. That's not exactly how we invest our money, but we'll talk about that a little later. And in terms of a comment he made, which you can see up there, as I've been nervous for a period of time, and I thought it was interesting when he gave his presentation, that's Bruce Greenwald, he said, for the last 5 years I've been worried about this or worried about that or worried about that. And he said, forecasting dramatic events is a waste of time. He said it is pure speculation. From our perspective, we like to sort of plan for the worst and hope for the best. And how do we invest our money? We're looking for undervalued growth companies, and we buy them when we can see a catalyst that's going to change the valuation. Otherwise, we'll sit in cash. So I am nervous about the market. We've been in a very long bull market. I think it's important that as investors that we don't overextend ourselves in these times, because there's enough grey hair in the room that we know that as the market goes up and everyone feels comfortable, there are periods of time where we feel very uncomfortable when the market's falling, and accept that one of those will occur soon. In terms of what else I'd like to talk about, the slide up there, which I'll come back to, is a few people have said, with our business, that over the last period, that you've added a lot. And I mean, the tough thing is, they said, Jeff, how can you do that? The fact is, I don't. We have a big team. We've got 30 odd people in the team now, and we've got very high quality individuals. In terms of one of the messages that I got out of the Buffett presentation was, he leaves you with probably 4 or 5 interesting messages, and it's the same each year, and it's over an 8-hour period of questions and answers. One of the messages he leaves you with is obviously the benefit of compounding, and how he did that this year. He talked about when he bought his first stock in 1942. If you put $10,000 in the market in 42, and if it only got the market return, it would be worth $51 million now. So the benefit of compounding. But the other thing he talks about is how to focus on what you're good at. And what we're doing at Wilson Asset Management is doing that. And how we're doing that is, and it's a combination of diversification and specialisation. And it's specialisation in terms of having people that are good at what they do. We've now got 10 people on the investment side, led by Chris Stott as Chief Investment Officer. And we have teams focusing on certain areas. Whether it's Chris overlooking the whole team, then it's Oscar and Martin and the boys focusing on WAM Capital, WAM Research, WAM Active. Whether it's Matt Halpton and John Ayub focusing on WAM Leaders. And then Katrina Burns, who's just come back to work with us, who will be focusing on WAM Global. So it's really, and she is putting her team together. So it's having the teams that specialise, but also it's having the diversity of people and thoughts and information. And as we add this global product, as when we added WAM Leaders, that adds significantly to the rest of the business, because we're collecting information which is high quality information, which we can use for our investment approach. Now, in terms of the global opportunities, to me, you look at that slide in 2 halves, the top half and the bottom half. Look at the bottom half. I mean, that's how the world's changing in terms of, with respect to artificial intelligence, electrification, e-commerce. And one of the interesting things, just being in the US, I was in a cab, I think we're going up 5th Avenue. I look to the right, there's a bit of a traffic jam. I look to the right, there's a guy pushing a big trolley. It's piled up with boxes. Half the boxes had fallen off, and they're on the side of 5th Avenue, and it was all Amazon Prime product. They're all had the blue labels. So we know the world is going to change significantly. in terms of how do we navigate our way through that? We know rising interest rates is increasing volatility, create more opportunities. And the first point up there on the far right-hand side, in terms of, we were talking about synchronised growth 12 months ago, or 6 months ago, and now the synchronised growth isn't as great on a global basis. It's now a little bit unsynchronised. So the challenge for us is to see what's happening globally, use that information for our new global fund, but also use it for the rest of the business. In terms of the new global fund, which Katrina Burns will be talking to you a little later, Katrina worked with us. She was the second employee on the investment side after Matthew Kidman, joined us in 2003, worked with us around the time we were trying to work out our investment strategy, went to London as a young lady with her then boyfriend, now husband, wanted to go and see the world, ended up working as a successful global portfolio manager over in London, and then was coming back to Australia in 2011 and said, look, Jeff, I'd like to come back and work with you again, and I'd like to manage global equities. As you all know here, our focus is managing listed investment companies. We're incredibly different to most players in the listed investment company space, where 98% of our money is listed investment companies. So when Katrina wanted to potentially manage a global portfolio, we said we'd only do it if we could raise some money for a global listed investment company. In 2011, you couldn't have raised a cent. The golden period of listed investment companies started around 2012, and we've seen a number of them over the last period. And so around 2013, Katrina ended up getting headhunted to another fund manager. Around 2013, I said, look, we can raise some money now. We'd love you to come back, and we'll do that. It didn't work with where Katrina was, so we were happy to wait. We waited 5 years. Someone asked me the question the other day, would you wait longer? And I said, we would have waited another 5 years. I'm not sure if we would have waited another 10 years. Because to me, it's not only, you've all been shareholders for a period of time, and you understand we have a very defined process of how we rate management, look at earnings growth, and only buy a company when we can see that catalyst is going to change the valuation. So we're trying to get the maximum return by taking the minimum amount of risk. And why have we started that way? It was because when I started the business a little over 20 years ago, it was half the money in the fund was mine, and the other half of the money was Reg Grundy's. And so probably as distinct from most fund managers who are just trying to perform relative to the market, I didn't want a situation where, say the market fell 50%, and I was down 40%, and I said, look, how good have I done? How well have I done? Because I've outperformed the market. I didn't want to lose a cent. So our investment process is all about not losing money, only putting money at risk when we think is the highest probability that we'll get a return. And the great thing about that process, that it works domestically and globally, but the process is only half the equation. The other half of the equation is the people. And that's why we're very prepared to wait for Katrina to come back. And I personally am very excited that she's come back and joined the team. And all of you on your seats, there's a WAM Global prospectus. If you're interested, obviously you're taking risk on global equities. You're looking at global small, mids and small caps, which is where we can see the growth opportunities, and it's unhedged. So be aware of that. Now I'd like to pass you over to Chris, who'll take you through the next part. Thanks. Thanks.
Good morning, everybody. For those of you I haven't met, my name's Chris Stott, the Chief Investment Officer here at Wilson Asset Management. I'm going to take you through the next part of the presentation, which will talk to you a little bit about what we're seeing from a domestic economy standpoint, and then a few key themes, investment themes that we've picked up in our travels over the last few months since we caught up in November last year, and then dig down into a few of our key stock holdings across our small to mid-cap portfolios, being WAM Capital, WAM Research, WAM Active, and WAM Microcap. But firstly, on this particular slide here, we talk about the domestic economy remaining below trend in terms of level of growth. And it's been a familiar story, unfortunately, for many, many years, and we've been at these presentations talking about economic growth here being quite sluggish. Inflation remains at the lower end of the 2 to 3% band that the RBA prefer it to be at from an interest rate standpoint. We're seeing a lack of wages growth. Unemployment remains fairly stagnant, and it's hard to see a specific catalyst that's going to get us out of this funk, if you like. And if we go around the grounds and have a look at what's happening on a state-by-state basis, Sydney and Melbourne, we've seen the housing markets peak. House prices in those particular markets are up anywhere up from 50 to 100%, depending on where you look, over the last 5 years, which is quite extreme. And we've seen the banks freely lending again, once again this cycle, to stimulate growth, and that's happened again. But you have seen house prices peak, in particular here in Sydney, where we saw house prices peak in July of last year. So the housing market's cooling. The banks are not lending as freely as they used to be, particularly to offshore investors. A lot of money was coming out of China into Australian property over the last 5 years. A lot of that activity has slowed right down. And as a result, we're starting to see house prices really starting to cool. We don't think that the housing market will undergo a crash in Australia, as some market experts have suggested. We think that we're in for a period where we're going to see, from a house price perspective, fairly sluggish growth in real price terms over the next 3 to 5 years. Meanwhile, we've got the mining side of the economy picking up again, and we would have spoken to you about in the last few presentations that we are starting to see signs of the mining side of the economy starting to pick up again. We've got the price of spot iron ore, coal, really recovering off their lows from a few years ago, and that's now starting to reflect in activity, in particular in parts of WA and Queensland. So we have positioned some of our portfolios to take advantage of this particular thematic, be it investing in companies that have got direct exposure and are beneficiaries of economic growth, in particular in WA. For example, one sector that we are invested in quite heavily at the moment is the mining services sector, and we'll talk to a few of those stocks a little bit later on. Meanwhile, interest rates remain on hold. They've been on hold for a very long time now, and there's no sign of them going up anytime soon. We're of the strong belief that the next move in interest rates will be higher, as we would have said 6 months ago, but there's no imminent reason or catalyst, we think, for the RBA, and as they've said in their minutes, to increase rates anytime soon. So we're going to get the interest rates remaining on hold perhaps for another 1, even 2 years. And we still have our cash rate at a record low, as we know, of 1.5%, which is the lowest it's been forever. So interest rates, and unless we start to see a little bit more inflation starting to return to the system, and that could potentially come from the more buoyant mining sector, and that could hopefully, we hope that the RBA do increase interest rates at some point, albeit it's quite a tricky situation at the moment with the mixed economic data, the patchiness of the domestic economy as well, which is making their job just that little bit harder. Moving on to, as you know, as a part of our investment process, we see over 1,500 companies a year where we're meeting with the CEOs and the CFOs of the particular companies, predominantly listed on the ASX. We also meet with industry contacts. They're typically the best ones to meet with because they've got no hidden agenda, they tell you the truth. And they're really valuable, insightful meetings in terms of understanding the dynamics of a specific industry. Now, as a part of that process over the February reporting season that has just gone past a few months ago, one key theme that came up from our discussions, in particular from media companies, is that there's a shift away from the digital advertising back towards traditional advertising. Traditional advertising being free-to-air TV, being radio, seen as old type media. There's been a shift in the last decade in particular towards digital. Advertisers have much preferred to advertise their product online, be it with banner ads or search engine optimization when searching on Google for a particular product. And why are we seeing this shift? And we picked up this feedback from a number of different media companies that are listed here: Channel 9, Channel 7, WPP, one of the largest owners of advertising agencies in Australia. All were saying that they were seeing this trend. And the reason why we're seeing this trend is that some of the advertisers are getting quite frustrated with their inability to measure the effectiveness of the digital advertising spend. In essence, for example, say McDonald's, they can advertise on Facebook. You're on Facebook, you see a McDonald's ad. There are organisations set up specifically to buy likes, where you can click on that particular ad and you say you've viewed it and you've liked it. There are organisations set up where you can pay them to deliberately view ads and view videos. So advertisers are getting frustrated that their inability to accurately measure the effectiveness of their advertising campaigns, and in particular not having the trust in terms of the data that they've been presented with, in particular over the last few years. So that's seen a massive shift back towards traditional advertising, particular free-to-air TV, and we expect this particular trend will continue over the next 1, 2 or even 3 years. And this is a particular trend that we are taking advantage of in our portfolios at the moment. Next slide being one particular stock which has been our biggest holding across WAM Capital and WAM Research for over a year now is Nine Entertainment Group, or Channel 9, the TV station. Channel 9 remains a core holding for us. We initially bought the shares at around $1.20, 12 to 18 months ago. The reasons why we bought into Nine Entertainment Group: they had a fairly new CEO, Hugh Marks, who continues to do a fantastic job in terms of moving the company more into the digital space and setting up the company for the longer term. We saw numerous catalysts identified at the time. Firstly, we thought there could be an earnings surprise. Channel 9 have upgraded their earnings 3 times in the last 7 months. So they've got significant momentum on the rating side of things. And finally, we saw that the cricket rights were up for grabs. Now, Channel 9 has been an institution for all the cricket fans in the audience, where in summer you put the TV and you put on Channel 9 and you watch the cricket. That's now finished. Channel 9 have lost the rights to the cricket. And you might say, well, Chris, isn't that a negative thing? Channel 9 were losing $50 million. We estimate they were losing $50 million a year by broadcasting the cricket. So now they don't have the cricket. That's automatically a $50 million profit upgrade. They've also won the rights to the tennis. So the Australian Open tennis will now be broadcast on Channel 9, effective the year 2020, where we estimate that they will lose a small sum in terms of broadcasting those rights. So net, the benefit for Channel 9 we estimate to be anywhere from $35 to $40 million in terms of an upgrade, given the losses that will no longer be there from broadcasting the cricket. Now, we have reduced our holding in Channel 9 more recently. It has been our biggest holding, but the portfolio weighting as a result of the share price appreciation got to quite a high level. So it's an important point to make in terms of how we manage risk, is that we really focus on our portfolio weightings and make sure that we're not having quite a diversified portfolio across a number of different companies, and where we can manage our specific portfolio weights in a more reasonable, digestible manner. So we still quite like Channel 9. We think the shares can continue to go north from here, and it remains a core holding for us across these 4 different portfolios. The second one which we'll talk about is Aveo Group. Aveo is a controversial one. For those of you who don't know, haven't heard of Aveo, they're predominantly an operator of retirement villages. They ran into trouble in June of last year when ABC Four Corners, broadcast a story talking about the poor experiences of their residents, getting charged high fees, poor levels of care. It was a PR disaster for the company. As a result, a few months later, Aveo came out and said that their inquiry level in terms of new residents coming into the facilities was down by 40%. The company had suffered. There was a lot of pressure on the CEO and a lot of pressure on the share price, as you'd expect. Now, we saw this as an opportunity. As we talk about, one of the famous sayings is, when there's blood on the street, get excited. We get excited when share prices fall a lot and we don't own them. it creates opportunities for us. And this was one such example where Aveo, where we've owned the shares in the past, we've got a very high opinion of the CEO, Jeff Grady, and we've actually made really good money out of Aveo 3 or 4 years ago, where the shares were trading at a 30% discount to NTA at the time of purchase, where we sold around NTA. The shares today are back at 30% discount to NTA. So we've reinitiated a position across our portfolios. We think the worst is past Aveo. They've come out to the market and talked about their inquiry levels being above where they were pre the Four Corners story now. So essentially, we're of the belief that for the company, conditions have normalised. Meanwhile, the share price has not reflected that yet, be it still trading at a 30% discount to NTA. When we look at the peers, the peer group across the market, in particular Ryman, which is listed in New Zealand, which trades well north of its NTA value. So we think that Aveo represents good value at these levels for us, and we're investing in Aveo across WAM Capital and also the WAM Active portfolios. The final stock I'll mention on this particular slide is Generation Development Group. This is one of our core holdings within our relatively new WAM Microcap portfolio, which is coming up to its 1-year anniversary next month. We initially started buying shares in Generation Development Group almost a year ago when we got the proceeds of the IPO back in June of last year. And what caught our attention with this one is interesting. And a lot of people say to us, Chris or the team, how do you actually come up with all your investment ideas? How do you go about it? It can be a number of different ways. Talking to industry competitors, stockbroker contacts, talking to competitors within an industry, a whole number of ways. Another way that we do it is at the end of every night, we go home, at the end of the day before we go home, and we scan all the ASX announcements for that particular day. So we go through all the different announcements, the change in substantial shareholdings, profit upgrades, downgrades, acquisition announcements, anything that we think catches our attention. The way we generated the idea to invest in this particular company, Generation Development Group, was one day, back just over a year ago, they announced that they had appointed a new CEO. The CEO, who is ex-Westpac, he used to be the 2IC to Gail Kelly at Westpac, so a really high credentialed individual, Rob Coombe. And we thought to ourselves, what is Rob, who was one of the most senior people at Westpac, why is he going in to manage a little microcap capped at $50 million? That looks interesting to us. Let's investigate that. We then went and met Rob and spoke to him about his plan for the business. It was previously named as Ausstock. They've just changed their name in the last few months to the Generation Development Group. And they've got a strategy in terms of growing the business, being in the funds management area in the investment bond space. Rob has built a very high quality team around him in the last 6 to 9 months, really high quality individuals that have joined the particular company. So we're of the belief over the medium to longer term that Generation Development Group can certainly has a big future ahead of it. Other things that we like, and just to give you an insight into our process, is that for this particular stock, there's no stockbroker coverage. I think there's only one other fund manager on the share register. The stock has I've never seen it being talked about. A lot of people, when you mention the name, say, I've never heard of it. All those things excite us. It's an undiscovered story still, we think. The market hasn't discovered it yet. And that's a big part of our process in terms of finding these undervalued growth companies and these companies that the market has yet to fully discover and, in our opinion, reflect the true value of that particular investment. Now, I'll leave that part of the presentation there. I'll now pass it over to lead portfolio manager of WAM Leaders, Matt Haupt, who has done a terrific job with WAM Leaders coming up to its 2-year anniversary this month. In the last 12 months, the portfolio has outperformed by 8% versus the market, which puts it right up there in terms of comparing it to its peers in managing money in that top 200 space. So thank you very much, and I'll now hand it over to Matt.
Thanks. Good morning, everyone, and thanks, Chris. The next few slides I'm going to talk about is the Royal Commission, the impact on stocks, specifically around the banks and wealth managers, Then we'll walk through some slides to give you a framework on how to judge the market going forward, then touch on oil, and then we'll go back to some of the stocks within WAM leaders. So the Royal Commission, highly uncertain the outcome. One thing I can guarantee is a lot of lawyers will get rich. This will cost between $300 and $500 million collectively between the government and the banks. So what is the likely outcome? If we look at the banks, the thing we've got to be aware of is the cost of funding and also the availability of credit. So at the moment, the banks, probably the biggest issue coming out of the Royal Commission is what is reasonable inquiry in extending credit or giving a home loan. Currently, the regulations state that you have to make reasonable inquiry, and this is either getting the expenses of somebody or using this measure they call the household expenditure measure, which is shortened as HEM. So the HEM is a blanket rule which is used across the population, which approximates the expenses. So the big debate is, do you have to collect every individual's expenses, or can you use this HEM measure? At the moment, the HEM measure is used between 70 to 80% of the time on home loans. So there's a big debate here. If you change the HEM, will credit be available to a lot of the population? And if you change this, the flow-on effects are quite dangerous for the economy, because all of a sudden your credit growth might fall from 5% to 4 to 3, and the whole economy will come grinding to a halt. So the regulator's in a real tough position. How hard do they go? So we think the Royal Commission, collectively, it's wiped off over $4 billion of equity value. So the market's already expecting changes. It's just how severe will the changes be? And like I was saying, logic suggests you can't go too hard, otherwise the flow-on effects for the economy will be quite dramatic. So we think the likely outcome is a staged approach from the Royal Commission, the recommendations, where there is a staged change to the household expenditure measure so the market doesn't fall in a heap. So the bank stocks at the moment have fallen in anticipation of changes and anticipation of regulation costs going up. We think the price fall has taken into account a lot of that. But we think the bank stocks still remain trading opportunities. So we're not buying and holding them within WAM leaders. We will be trading these stocks. There'll be moments where they'll get sold off, and there'll be moments when they run quite hard, and we'll hope to capitalise on this like we've done previously. So in the leaders NTA, sometimes you see the banks go in there. They're actually, a lot of the time, short-term trading opportunities. We're not a buy and hold on the banks at the moment, and we still think there's enough regulatory noise in the banking sector where you can't sit there and leave them as a buy and hold. On the wealth management side, obviously AMP has taken a lot of the headlines away from the banks. What's going on there looks quite disgusting from the outside looking in, and we think AMP going forward will be in a world of pain. They may get enforceable undertakings, there's all these lawsuits outstanding. It looks like a real issue at the moment. So for us, to buy AMP at this point in time, it's too early. IWF, on the other hand, is looking quite attractive. It's fallen almost as much as AMP and hasn't had any of the issues so far. But there's a big debate with the Royal Commission. Will they separate advice and will they separate platforms? If that happens, some of these businesses can be broken up. And as you've seen with the banks, they've divested a lot of their wealth management businesses anyway, or in the process. So we think the banks in the wealth management space are already on the front foot and getting away from this. So we think they'll return to their core banking, and we highly support this move from the banks. So the next slide here is just walking through why the equity markets have gone up and what the central banks globally have done. So you can see there, central banks have injected over $13 trillion of stimulatory monetary policy or extended their balance sheets. So effectively, they pushed money out into the system. And why did they do this? It was in response to the GFC. They needed to keep interest rates artificially low so economies could expand again. So you can see there, anything above that line is expansionary, and then anything below is contractionary. So the ECB They tried pulling money out of the system with fiscal austerity, but that didn't work, so they went back to printing money. But going forward, the Fed will be the leader in this. They're starting to pull liquidity out of the market. So when the US pull money out of the market, it sends their interest rates up. So what you're seeing now is US interest rates on the march, which will have a negative effect on equity valuations at a point in time. At the moment, they're still very much under the neutral rate, so there is no real impact yet, but we think it will lead to a dramatic impact later down the track. The ECB are still printing money. We're still finding it hard for them to pull out of the equation. And the Bank of Japan, again, they've been doing it for 20 years. We expect this to continue as well. So the monetary policy globally is still accommodative, but it is getting less so. So you have to take this into account when you look at equity valuations. So this next slide, we're saying, are the bears coming for Goldilocks? Because probably the term being used recently is we're in a Goldilocks period. Growth is not too hot, not too cold. Monetary policy, not too hot, not too cold. So the Goldilocks has been thrown around as a key word to describe the markets we're in, which is probably correct. Growth is going well and monetary policy is still accommodative. Nothing's out of kilter at the moment. But as you can see here, this chart is showing the Fed expectations. So every time the Fed have a committee meeting, all the members in the Federal Reserve in the US have to put their interest rate expectations on a chart. So this chart is showing you the Fed expectations of rates. So you can see there, they were effectively at zero interest rate for a long period of time. Past the dotted line, you can see the forecast. We're going up in rates in the US. This has a very mechanical effect on equity valuations. As rates go up, equity valuations go down because you've got to use a higher discount rate. Also, it impedes growth within the economy. It makes the cost of money higher. So we'd expect over time, conditions will get tighter and equity valuations will roll over. But the big debate is, what is the neutral rate in the US at the moment? The neutral rate is the rate at which the economy is balanced. It's not restrictive and it's not accommodative. So we're thinking the neutral rate is around 2.9%. So the Fed is well below this neutral rate. So if the Fed keep pushing up rates below 2.9 level, in essence, the economy should keep expanding. So there's a big debate. If the Fed move, when will the market roll over and when will the economy roll over? And we expect it not to be rolling over before you get to that 2.9% level, which is the neutral level. This is a really interesting chart. This one's showing you the returns in equity markets before a recession happens. So we're saying interest rates are going up, the economy will slow, and like Jess said at the start, is the end near? Well, it is, but you want to be there for that last period of time before it rolls over too. So on that table, you can see the circled area down the bottom there. The period 7 to 12 months before a recession, you get extraordinary returns. But if you hold on for too long, that 1 to 6 month period, you can get some quite big negative returns. So the trick with all of this is try and time the market, which is next to impossible. But you've got to look at the key factors here. In the US, you've had a $1.5 trillion tax cut benefit and then a $1.3 trillion fiscal benefit in 19. So essentially, you're in the mid to late stages of the business cycle in the US and you're getting all this stimulus thrown at it, which is not really the way to play it. You generally throw stimulus at the start of the cycle to get it going. So we think the US will overheat. We think the Fed will have to push up rates to accommodate this. So if you look at the timeline, 2020 looks like the time the US might slow down and you might get a technical slowdown or a technical recession. So if you wind back the clock, you want to be looking around 2019, middle of the year maybe, as a potential time to exit the market. But that last period, you can get extraordinary returns. So it's just an interesting way to look at it. Like, we know the market's coming to an end, but you really want to stay there until you get that last blow-off phase, which is where you make a lot of money. The next chart here is around OPEC and the energy markets and oil. So in 2014, OPEC essentially fell apart. The quota system, which is run by OPEC members, is a cartel, which is illegal in the developed nations, but due to international law, you can't take sovereign nations to court. So the cartel works to control price and supply into the market. So in 2014, it fell apart, and they did this to try and squash the US shale industry, which did work, but oil went down to $23. And all these countries were losing money. So it backfired on them, so they had to come out and rearrange the deal. So in December 2016, they came out with a quota system again. So all members are producing within their quota, and you've seen the oil price rally from the low 20s to over $70 a barrel now. So it has worked, and the goal of OPEC at the time was to get oil inventory levels back to their 5-year average. And as of the last few months, that goal has been achieved. The oil inventory was 330 million barrels over the 5-year average, but it's come back to the 5-year average now. So the big debate is, will OPEC extend their current agreement? They have a meeting in June to decide if they keep the current arrangement, which runs out in December. We think they will keep an ongoing relationship going, basically due to Saudi Arabia. Saudi Arabia are looking to float their Aramco business, which is the oil business. They're looking to get $1 trillion for this. They need a high oil price. That has been one of the biggest motivations of OPEC, and Saudi Arabia have led the cuts. They're cutting the biggest out of the OPEC members. They're cutting around 500,000 barrels a day. So they are driving this. It's amazing they can get a deal done, because within OPEC, Iran is a member as well, and Saudi Arabia and Iran at the moment, they hate each other basically. So we don't know how this meeting will go in June. We expect it to be continued. But going forward, it looks like Russia, which is a non-OPEC member, they want to have an extended deal as well for more price stability. So what does this mean for Australian investors? Well, within WAM Leaders, we've participated in this through having stocks like Woodside, Santos, Origin, and Oil Search. So we positioned ourselves in these stocks around 12 to 18 months ago, on the back of these cuts led by OPEC, thinking that we'd get a recovery in the oil price. We think the oil price around $70 is quite fair under the current arrangements. Global growth is going well, so demand is actually exceeding expectations at the moment. So the oil market looks good. Excess oil inventory is gone from the system, so we're quite constructive on oil still. As you can see there, quite a lot of the names are exposed to oil, and even BHP. So BHP have quite a large oil business, and that's the first stock I'll talk about within the WAM Leaders portfolio. So BHP, we've had that for a period of time now too. Probably the key thematic around BHP has been the divestment process and the paying down of debt. So at its peak, they had around $35 billion of debt. Currently, we estimate it sits around $10 billion of debt, or $10 to $12 billion of debt. And we think a big catalyst will be the divestment of their oil business, which is the onshore oil in the US. So bids are due for this in June of this year, so in the next month. A whole list of people who are interested in the assets will be coming out. So publicly, BP have said they've got interest, Shell have said they've got interest, and we think they can get between $8 and $10 billion for their oil business, the onshore oil business. The other thing BHP have got are franking credits. So they have $13 billion of franking credits on their balance sheet. So we think if they can divest their onshore oil business, there's a high probability that they'll pay out a special dividend, which could be as big as $3 a share, we estimate. So I think there's an immediate catalyst coming up, which is quite positive for BHP. With investing, there's always pros and cons. So on the cons side, they have the Samarco issue to deal with still, which has been extended out every 3 months for the last 12 months. But again, that is coming up, and we're unsure of the fine they'll get or the remediation they'll get through Samarco. There's talks of it could be $1 billion to $5 billion to $20 billion. We just don't know. But we think there's a low probability that it'll be big enough to make an impact for them on their divestment program and also on their payments back to shareholders. So we're staying constructive on BHP. China hasn't slowed down as aggressively as people thought. The iron ore market's looking good, copper's good. And generally what happens in the late stages of a business cycle, commodities run, generally because basically you get inflation and global growth happening at the same time. So resource companies do well in the late stages of a bull market. Hard assets are what you want to own, and this is proving to be the case currently. The other stock we'll talk about is Macquarie Bank. Macquarie Bank has been a great stock for us. The reason why we own Macquarie Bank is we think they have high degree of certainty around their earnings. Macquarie Bank, the perception still it's an investment bank that earns all their money through stockbroking, through debt markets. But in reality, it's the biggest player globally in the infrastructure market, infrastructure management. So 70% of their earnings is recurring. And what they've been doing post-GFC is investing seed money in assets and vehicles, which they get to realise over time. And we're going through that harvesting phase now. So the last 3 results, they've upgraded their earnings. And we think there's a high degree of probability that they can keep doing this for the next 3 to 5 years. They always come out with guidance broadly in line and then do 10 to 12% growth. So every year they set the benchmark really low and over-deliver all the time. So we're still very constructive on Macquarie Group. It's still a core holding within WAM Leaders and Century. And we think there's a high degree of certainty around their earnings. The other stock I'll touch on there is James Hardie's. So James Hardie's, approximately 80% of their revenues earn offshore, predominantly in the US. So James Hardie's, they do the siding for houses in the US, fibre cement. The reason why we like James Hardie's is with these manufacturing businesses, quite often you get opportunities to get into them when they have production issues. So James Hardie's was running in the US and demand was spiking and they had all sorts of production issues because demand was too high for them. They were trying to run shifts, they had staffing issues, and they're just basically running their plants too much. And they had breakages and outages, and the cost of transporting goods from other places meant their earnings fell in a hole. To make money in the market, you've got to have a view that's not consensus. So when we were looking at Hardie's, we thought, are these production issues terminal? And the key for us was demand was the issue, which is great for a company selling product. Demand issues is what you want. So we thought if they can get their production issues sorted, there'd be a lot of money to be made in James Hardie's. So we were buying this around $17, $17.50, currently trading around $24. But we still think there's a high degree of certainty around that demand profile, and we think they can upgrade their earnings over the next few years as they meet the growing demand. The problem with Hardie's, I guess, is they've had a long-term CEO who's hinting that he might leave. We think the structure in place now, there's enough executive capability. They've been building that out. So we think these will be short-term issues. And with Hardie's, the overall thematic around the industry is quite positive. So in the US, housing starts run at 1.5 million per annum. That's the median. Currently, we're running around 1.2 million. So you can see there, if we just go back to the average, Hardie's has a lot of upside left in it still. So we're quite excited by the opportunities there. They come out with their quarterly on the 22nd of May, if you want to watch that. I'll now hand over to Katrina Burns, who'll be talking through the global side of the WAM group. And we're extremely excited to have Katrina because within WAM Leaders, about 70% of our positions have offshore earnings. So we think having Katrina on board and her team will give her great access, will give us great access and information flow. So I think all shareholders will benefit from WAM Global, even if they don't directly invest in WAM Global. Thank you.
Thanks, Matt. So I'm extremely excited to be back at Wilson Asset Management. It really is an extremely unique business and really lives by the values of making a difference for shareholders and the community. And having gone away and worked globally and then come back to Australia, I really recognise, what a unique culture and business it is. So very excited to be back and to be the lead portfolio manager for WAM Global. So I thought I'd just run through all the major regions around the world where we've been in the last few months, and then give a bit of a view in terms of where we are in the market, and then some individual stocks that we think are interesting at the moment and potential investments for the WAM Global portfolio. In terms of, if we look globally, as Matt pointed to, we really are in a bit of a Goldilocks period, particularly in the US, where you've had low volatility over the last year, but if we look forward, interest rates are no doubt going to go up, and we think that volatility will increase. But as an active fund manager trying to pick individual stocks, we think that's really exciting because when everything gets thrown out, we can find individual stocks that fit our process that are really interesting and have long runways of growth. If we go through just in terms of how WAM Global will invest the money, it's really about taking WAM Capital, the original listed investment company that Wilson Asset Management did in 1999, and taking the same process and looking at stocks offshore. And in terms of how we invest the money, it's really both qualitative and qualitative in terms of our proprietary ratings process. We take a very strong view in terms of rating management, looking at an industry position, assessing the earnings growth potential of a business, and then comparing it to the valuation. But we will only invest in a stock if we can identify a catalyst that will re-rate a name. In terms of going through the regions, I've been in every major region around the world in the last few months, and I thought I'd just go through what we've seen on the ground in terms of the different countries around the world, starting with the US. So I'm back last Tuesday from the US, and the economy is certainly firing. If you look at the latest quarterly earnings that we've just gone through, 90% of companies have now reported, and over 80% of companies have beat expectations. So, very strong growth. And if you look at the different pockets of growth where it's really firing, as Matt pointed to when referring to James Hardie, the housing market is still operating on all cylinders. Medium-term average starts, as Matt said, are 1.5 million. We're still well below that. So we think there's a decent runway of growth in terms of the housing market. There's no doubt Amazon is having an effect on the market. And if you look at, in terms of Prime, which is their service they offer, if you pay $100 a year, and they've recently announced that's going up to $120, but if you pay $100 a year, you can have 2-day delivery on anything ordered on Amazon. And that's really taken away any friction in terms of ordering online. And anecdotally, speaking to people particularly in New York, that they're getting a box delivered a day from Amazon. So there's no doubt that that's having an effect on the retail sector. But within that, there's certain pockets that are still doing extremely well. So you've got the Procters & Gambles, Unilevers, Nestle's of the world that are struggling. They haven't innovated well. But then if you look at what's doing well, it's travel retail, luxury goods, and beauty. So there's certain pockets, and actually the other one is spirits, so alcohol. So there are certain pockets that are still growing very well, but they're the other areas of the world, other consumer products that are struggling and haven't innovated, so they're not doing so well in an Amazon world. If we look at other areas that are doing well, it's companies that are geared into the infrastructure spend, and Trump's policies, we'll see if he gets through the midterm elections in November, but that, there could be another leg there which will only help further. If we look at some of the companies that we've met with that we think are interesting and that are really geared into that growth, Waste Management would be one. Now, this is the biggest waste management company in the US, 2 times than its next biggest competitor, but yet trades, if you know the Clean Away business in Australia, it trades on 24 times multiple. This business trades on 17 times, and yet has a far stronger growth profile. And you know, it's been sold off recently on some concerns on China recycling, but it's 10% of the business, and it has a strong runway of growth ahead. And you know, if you look at the worst it did in the global financial crisis, volumes were off 5%. So we think, you know, even in an economy that might slow down, the downside, you know, is limited. If we look at other businesses we think are interesting, Lear Corporation, they're the number 2 player in the manufacture of car seats and truck seats. So it doesn't matter if the fleet is going hybrid or going electric or going autonomous. You're still going to need a seat to sit in, and they're the number 2 player. The number 1 player, Adient, is highly leveraged, has had integration issues with an acquisition it did in Europe, and is losing share, and has had quality issues, which is a no-no in the car and truck manufacturing industry. This business trades on an 11% free cash flow yield and has bought back 40% of the shares on issue since 2011. So, you know, just another example of an exciting business in the US that we think will do well in the coming period. Turning to Europe, I mean, there's a lot going on. If you look at the individual economies, Merkel's back into government, but with a lower majority. If you look at France, Emmanuel Macron is trying to implement labour reforms, which we think would be extremely positive for the French economy. Companies operating in France have historically there's been low flexibility in terms of changing out the labour force in times of slowdown. So if he can get some of his policy reforms through, we think that'll be very good for a lot of the French companies operating there. In Italy, you've got a populist government in place now. So there's a lot happening on the macro front, but we think underlying that, there's some really interesting individual stock ideas that are really exciting. And I'll point to one there, Scout 24. So this is the REA car sales of Germany, or of Europe, based out of Germany. And it's interesting, the CEO of REA in Australia, Greg Ellis, who was CEO from 2008 to 2013, has gone to run this business. And if you look at, you know, this company's capped at 4 billion market cap. REA, much smaller market in Australia, capped at $11 billion, with a region in the much earlier stages of adoption, the move from print to online. And we think he's a value creator. He oversaw the REA share price go from $5 to $38 whilst he was running the business in Australia. Second one there, Logitech. Now you may know the mouse, you know, your keyboard or your mouse, that is a Logitech mouse, but that's not the exciting bit of this business. So this company has a really high quality management team and a focus on R&D, and 10% of its market cap in cash. But the growth area of this business is actually gaming. Now, my sons are too young to be into their gaming yet, being 3 years old and 10 months. But I know a lot of people with older sons very into their gaming. And if you look at the growth Logitech's experienced in the last 5 years, they've seen 30% growth in their gaming business over the last 5 years, and that's the headsets that gamers use. So, you know, you might think it's just keyboards and mouses, but it's, you know, there's a growth trajectory underlying that from the gaming industry. And if you look, they actually have partnered with Amazon for their Alexa product, and have a partnership with Apple and sell in Apple stores, so not under threat from those guys. If we turn to Japan, Japan's been a really interesting place, you know, for, you know, post the crash in 1992. The economy's really struggled. and a huge amount of monetary policy to try and stimulate the economy. But underlying that, there are some really fabulous businesses that have grown incredibly well, even with an overarching economy that's struggled, and with demographics that don't look particularly favourable from the outset. And also that are, you may have high public debt, but the Japanese consumer has tended to be a big saver. So you've been left with a market that has housing stock that's incredibly aged. So we think there's some really interesting plays on that thematic. I mean, you've got the Olympics coming up and the Rugby World Cup. So there needs to be a refresh in the property market in terms of the housing stock. And we've found some interesting companies, Open House Group there being one, which trades on a 10 times PE multiple, growing over 20%, and really benefiting from that housing stock refresh. So that's just a whip around in terms of the region, the major developed market regions that we've been in the last few months. And just to give you a bit of a flavour for the exciting opportunities we can see globally, we think there's a sweet spot in that small to mid-cap space, and small to mid-cap globally is not your small to mid-cap in Australia. MSCI classifies mid-cap as 25 bill and under, so it's a lot bigger. But we think there's some amazing high-quality businesses that have exciting growth trajectories that will form a really exciting portfolio for WAM Global. So we're really excited about the launch of the product and can't wait to get started. So thanks.
Thank you, well done. Thanks, Katrina. So for those of you who I haven't met yet, I'm Kate Thorley, the CEO of Wilson Asset Management, and it's great to be here today and to see so many shareholders come along. The team and I really love the 6 monthly roadshows because it's just a great chance to spend time with our shareholders and to get to know you and to answer any of your questions. So in terms of WAM Global, which we've all talked about today, you've all got a prospectus that was on your chair when you came in. So the offer is currently open and we're looking to raise no more than 550 mils. So we have said very publicly that we'll be capping it at 550. So, and initial response has been really strong. So we've had well over 30% of our current shareholders already apply. And so thank you very much for those of you who have applied so far. We have carved out 30% of the offer for our current shareholders, for anyone that's been a shareholder in the past, and for any family and friends or people that are signed up to receive our email on a Friday. So you do get a priority allocation for this current offer. At the moment, the closing date is the 8th of June, and the shares will hopefully start trading on the 22nd of June. The issue price is $2.20. There won't be any options attached, and the investment manager, which is Wilson Asset Management, will be paying all the offer costs for this IPO. So essentially what that means is you'll put in $2.20, and on day one, the net assets of the company will also be $2.20. We'll probably crash the Wi-Fi doing this. So if you just put in your name and your email address, I'm doing it as we speak as well because I'll be impacted, and then submit, sign the petition. So if you can all do that now, we'll take this petition and we're going to lobby really, really hard on this issue because we know that as shareholders, you need stability on this issue. You need stability. We don't want either side of government to keep changing the goalposts on our shareholders. So this is just something that we're doing in terms of wanting to help give you a voice on this matter. This is the team and myself. We celebrated a really, really big milestone in the business. Firstly, in January, most of you will know that our founder, Jeff Wilson, received the Order of Australia. Now this was, obviously a huge recognition and very well deserved for Jeff. It was for his contributions and impact that he's made in terms of the industry, but also in terms of philanthropy. And a big part of that was Jeff finding the idea behind the Future Generation vehicles in the UK and bringing it back to Australia and bringing it to life. So we were all very proud of Jeff to receive the Order of Australia and also to celebrate 20 years in business. And again, everyone that's here today, you've all been a part of that success and you've all been a part of that journey over the last 20 years. So thank you very much for that. I'm now going to invite our speakers back up on stage, and we've got some questions that have been sent in over the last couple of months, some common questions that shareholders have asked. So I'm going to moderate those this Q&A session, and then we're going to open to questions from the floor. Thanks, Jeff.
Thanks. Yep.
So while we're just getting set up. So the first question is, how will we be able to continue to find opportunities in the market if and when the next bull market ends? So perhaps Jeff and Katrina would like to answer that.
Yeah. Ladies first.
Ladies first. I knew he was going to say that. Sorry, Jeff.
So I guess in terms of how Wilson Asset Management runs money, it's really about finding individual stocks that fit our process, and if we can't, we'll sit in cash. So we do tend to have higher levels of cash than your average fund manager. So if you look at WAM Capital, for example, over the last 19 years, it's held on average 34% cash. So in times if the market corrects, we will tend to be able to take advantage of a market correction, even with the existing portfolio. Saying that, I guess, our view on where we are in the market is that we are further along in terms of the cycle and more in the mature end of the cycle. So in that case, if you look at, say, the WAM Capital portfolio, if you look at where it was 5 years ago versus where it is today, it's got a more liquid portfolio, I think would be fair to say, Chris. So we really, if the market corrects, we think that's exciting, and we'll find even more stock ideas that'll fit our process. But we're really fundamentally, bottom-up stock pickers that are looking for individual names that fit the process, where we can identify a catalyst that will drive the valuation. So if we can't find those stocks, we'll sit in cash.
Terrific.
Yeah, and I mean, from my perspective, one of the interesting things is, as human beings, one of our biggest drivers is fear. And the strange thing about being a fund manager, you have to work against your emotions, which is good for investing, not necessarily good for relationships. And it's, it is, when the market is very fearful, that's when we get excited. And in February, when the market had a bit of a hiccup, I was thinking, you beauty, the market's going to fall significantly, and when we launch global, the market will be significantly lower. That wasn't the case. But in terms of the opportunities that we see, it's when any major correction occurs, that's when, as investors, we get very excited. And to me, it's inevitable that markets go up and they go down. We all accept that. And at some point in time, the market will fall. And in terms of, as a fund manager, the great thing about our structure is we have that flexibility to flex up our cash weightings. During the GFC, we went at WAM Capital, we were up to 70% cash. At various points in time, we've been sort of 98% invested. And it's not, what are your equities going to come down by, when the market does come back. It's really how quickly you make your money back. And after the GFC, I think it took the market, this is the Accum, it took it about 7 years to get back to its previous high, where with WAM Capital, I think it took us a little over 2.5 years to get back to where we were before the GFC.
Thanks, Jeff. How have you grown the team to manage WAM Global? Jeff, would you like to?
Yeah, and this is probably what I talked about a little earlier about the sort of the specialisation, and it's really as there was a question yesterday that someone asked, they said, look, Jeff, how are you going to do all this? The fact is I don't. Now, the fact is you have good people that I can stand on top of their shoulders and do it. To use a racehorse term, which I like, is the Melbourne Cup. When you're looking at the form of the various Melbourne Cup runners, and I know you maybe it's a bit egotistical. I'm calling myself a thoroughbred, but let's put that to one side. And you get a couple of the horses, will be from the UK or Ireland, and those horses, the weird thing is, even though they're running in the Cup, they only run 1 or 2 times a year. That's me. See, this is my period where I'm actually on the racetrack. When the roadshow finishes, I'm off on holiday. So yeah, it's all about balance in life. But in terms of getting back to your question, what was it?
The WAM Global team.
Yeah, it was just waiting for the good people, isn't it? And finding the good people. And it's going to be Katrina. We've already got Nick, who's joined us. We found him in London working for Fidelity. We employed him a month or so ago. He's due to be back out here next month. And Katrina will have another person. And it's really just having high quality individuals that specialise on that area. And as we sort of indicated before, what that'll do is not only be great for investing in the WAM Global product and the performance of that product, but the other teams will all get the flow and effect. We sit in an open plan office, so the communication is very important.
The next question relates to how WAM Leaders has performed. So Jeff, do you want to perhaps comment on WAM Leaders in terms of the performance and the share price, and then maybe Matt, you can comment a bit.
Yeah, I mean, of all our listed investment companies, Leaders is the only one that's trading a bit of a discount to NTA. And as we talked about earlier, I'm a value investor. I assume everyone here is a value investor. We like buying $1, for less than $1. So when, say, WAM Capital or WAM Research is trading at quite a premium to NTA, 20% plus, we don't like paying $1.20 for $1. Leaders, the NTA is $1.18, the last stated NTA, and the share price around that $1.13, $1.14. So it's a little bit of a discount. Now, why is it a discount? When we flooded WAM Capital, even though we paid a 12-cent fully franked dividend on $1 for the first year and 14 cents the second year, we were still at a 20% discount. And it just takes a bit of time for your share register to tighten up. And with WAM Research, the fact that a significant number of options got exercised, 95% of the options got exercised, and that there was a lot of people selling the options, because when we raised the money for WAM Leaders, we had 42 new financial planners in there. And of course, they're not going to double their asset allocation to WAM Leaders, so they were net sellers of the options. A lot of arbitrageurs got involved. We've got to work through that. I mean, there was one arbor who put $20 million into WAM Leaders, just trying to pick up a little bit of money. And so to me, we've doubled the size. It's just going to take a little bit of time for the register to tighten up. And I mean, in terms of the performance, if you'd asked me a year ago at this presentation, do you think WAM Leaders could outperform the market by 8%, which it has, then I would have said, geez, they'd be doing bloody well to do that. And they have. So, so to me, there's no reason why it shouldn't trade at NTA or if not a premium. And to me, that'll just be time.
Terrific.
And Matt, do you want to talk about
I guess from our point of view, one of the things I sat down with John at the start of the year, we set a goal to try and beat the market every month this year. And so far we've done that with 2 months to go. So extremely happy in how the performance has gone. And I guess the biggest thing, we try to challenge ourselves around not going back to first order thinking, which is if something happens, then that's the outcome. Because the only way you make money is when you're right and other people are wrong if you want to beat the market. So we constantly challenge ourselves to try not to fall in the trap of this happens and that will be the outcome, but try and think of that, okay, that's what everyone else will think, but how can we be different? What can we bring as investors that's not in the current market price? Because that's the only way you're going to beat the market. So we challenge ourselves every day, back and forth on that topic, and try not to fall in that trap of just being consensus, because consensus, you'll never make money more than the market. So probably the most pleasing thing within the 12 months too was making money out of the banks, the Australian banks, when they've effectively been flat. We've profited from them 3 times, once around capital when the market thought they had to raise too much capital. Around 30 or 40 billion was the consensus with the analysts, but again, that was consensus. We're thinking, well, logically, will the regulator come out and impose 30 to 40 billion dollars of capital within the banks? Because if the banks have to hold more capital, their returns go down. And if their returns go down, they have to charge more. So is a regulator going to implement something when the economy is fragile, which will increase the cost of funding and the cost of home loans? And our answer was no, like it didn't make sense at all. So I guess that's an example of where you've got to think, that's probably the outcome, but logically, can that actually be the outcome? And the answer was no, and fortunately we were right, and the banks rallied strongly off the back of that. So again, that's just sort of an example of where you've got to think, that's consensus, but what is the real answer? And I guess around energy was the same as well. When all the energy companies had high debt and the energy price was really low in oil, and we were thinking, well, Saudi Arabia, like I talked about, they have a massive incentive to get a high oil price, and will they be compliant with OPEC cuts? And our answer was yes. And then the oil prices rallied from low 20s to be above $70 now. So making those calls, and then we're fundamentally a bottom-up stock picker. So I always think you want to be in an industry with tailwinds. You don't want to be fighting the industry. So you want to be in an industry with tailwinds, and then you select within those industries from a bottom-up perspective what are the most attractive companies. So all in all, it's been pleasing, and we've got a month and a half to go, and hopefully we'll get our goal of beating the market every month this year, which you can watch in the NTA. So we've got 1.5 months to go, so fingers crossed we can get there.
That's great. Thanks very much, Matt. In terms of WAM leaders and Century Australia, we took over managing Century in April last year. It's focused on the ASX 300, leaders is ASX 200. Some shareholders have said at some point, does it make sense that we perhaps put these vehicles together? Jeff, you sit on the board of both. Do you want to comment on that?
Well, that's obviously, I'm one member of both boards, that's all. Obviously, that's it. I mean, a number of people have asked about that. That's obviously a decision for the boards. In terms of, from our perspective, obviously it would be easier if it was just one vehicle, less administration. So it's really a decision for the boards. I mean, there is logic because Leaders is focused on the top 200 and Century is focused on the top 300, and we manage both.
Perfect, okay. The next question that I like to put to perhaps Chris and Matt is, in terms of investing, you don't always get it right. And, perhaps for our shareholders here, can you talk about a stock that potentially didn't play out how you thought it would, and any lessons that you learnt that shareholders can probably take away today when they're looking to invest?
Thanks, Kate. How long have you got? One that sticks to mind over the last 12 months was an investment that I made in a company called CSG, which was one of our initial investments in the WAM microcap portfolio. The company, we'd had a good experience with them in the past. Shares had gone from 30 cents to $1.80. Strong management team, good leadership. Just run into some tougher times over the last few years with the share price coming back to 70 cents. And at the time of the deployment of the capital for WAM Microcap, we thought this looks interesting again. We met with the company, we got comfortable with it. Unfortunately, we were a bit too early. The company we invested in June, the company put out a big profit downgrade in August at their full year result. And I guess one of the key lessons, if you like, is, and we've spoken about this before, and in a sense are guilty here of breaking one of our rules, is that when a company downgrades once, our research tells us there's a 33% chance of there being a second and a third downgrade, and so on. And vice versa, for companies that are upgrading their earnings, that positive momentum generally continues. So in essence, we were too early. We're trying to call the bottom on CSG's share price. We failed to do that, and we sold out of our position at a loss at that particular point in time. And since then, the share price has continued to trade lower. So, Kate, that's one example of a mistake. There's plenty, unfortunately, but we had more winners and losers, obviously. But yeah, good lesson there for us, and that's one that sticks to mind in last year. So, Matt.
Yeah, very similar to Chris as well around management and downgrades.
I thought very similar to Chris, as in I can spend all day.
Oh yeah, we could spend all day as well. Around Boral's investment, I think we're even preaching there or praising them about 12 months ago. So Boral came out and did an acquisition of a company in the US, Headwaters, which we thought the industry dynamics were very favourable. They had one slip up, and this is where we made the error. They had a slip up. We thought it was just slippage within the deal, so we held on. So they had a profit miss. Then they came out again, and as Chris was talking about, one typical leads to multiple. The issue we had here, we thought the industry dynamics would save them in spite of this, because the industry dynamics were very strong. So the infrastructure on the East Coast was running incredibly well. You had dry weather, you had volume and price going up, and the US housing market and infrastructure market was going incredibly strong. So we thought, sure, they had a slippage, maybe it was just a timing issue, but just recently they downgraded again and the stock fell. So the rule was when they missed, we should have got out. The CEO is an eternal optimist. You can have that for a code word for something else. And he keeps promising but failing to deliver. So again, the rule was, as Chris said, a downgrade, you move on, unless there's something like a one-off issue. But you can pretty well identify, like if the industry dynamics were strong and they downgraded, something's wrong there. So we held on for too long and we copped that second downgrade. Overall, we made money on the position because we bought much lower down, but it hurt because we left money on the table. We should have sold out earlier.
Okay, great. WAM Global, Jeff, how's that different to Future Generation Global?
Future Generation Global is a group of the smartest fund managers the investment committee of Future Generation can find, and that's there's 12 to 14 fund managers that manage that. So it's actually, you have a lot of diversity in terms of those fund managers and the various management styles, where WAM Global is effectively it's our process in terms of undervalued growth companies, and it's specifically looking at those undervalued growth companies on a global basis. So it's probably the difference between buying one stock and a portfolio of stocks. So you're getting a lot more diversity with FGG, where with WAM Global you're effectively backing Katrina and the team, and I suppose it's a little bit like FGX as a whole lot of fund managers, and WAM Capital is a specific manager.
That's great. In terms of WAM Global, a common question is how or will it pay fully franked dividends? Jeff, do you want to comment on that?
Yeah, the plan is to pay fully franked dividends, as all our entities, that's the plan. In terms of the ability to pay fully franked dividends when you're investing globally, you don't get the free kick of the fully franked dividend from the shares you invest in Australia. So, say if you look at WAM Capital, for example, WAM Capital's dividend at the moment, it's giving you about a a 6% yield on the share price, but a 7 and a bit% yield on the asset backing, a little under 6, but a little over 7 on the asset backing. So how does that yield come about is probably 2.5% of that, or a third of that, is dividends we receive, fully franked dividends from other shares we've invested in Australia. The rest of our ability to pay the fully franked dividend is our ability to make profits. So it's a combination of the two. So with WAM Global, you won't get the free kick of the fully franked dividends from Australian entities. You'll just get you'll pay the 30% tax, and you'll just be able to pay out the profit. And so that's the plan. The plan will be, again, to give you a growing stream of fully franked dividends. Will there be a dividend in the first period to December? It really depends how profitable we are. So if anyone here could tell me what the portfolio will be up in the first 6 months, then I could give you a guess of what the dividend will be. But the plan would be, there'll be a high probability, I would say, the first year there'll be a dividend, and the plan would be to start growing it over time.
And Jeff, I'll just, in terms of the dividend outlook for the other listed investment companies, would you like to comment?
I mean, our ability, as I just talked about how we pay our dividends. Our dividends are a combination of dividends we receive plus profits we make. So it's a combination of the two. And that's one of the great things about listed investment companies versus trusts, is the fact that you can, and that's why probably 60% plus of our shareholders are self-managed super funds, is because we have the ability to effectively smooth dividends, so give you a consistent growing stream of fully franked dividends over time. Just sort of going around the grounds, say with WAM Capital, that's got a year profit reserve in the bag. So if we don't make any profit in the next 12 months, then of course there's risk on the dividend. Assuming we make profit in the next 12 months, then that profit reserve continues to grow, and you can see that. If you look at our profit reserve on a 6-monthly basis, you can see how much is in there. With WAM Leaders, we've got, I think, about 1.5 years in the profit reserve. Then we've got WAX is WAM Research, a little over 3 years in the profit reserve, and WAM Microcap, we had a cracking start with WAM Microcap, so we've got about 4 years in the profit reserve.
WAM Active?
WAM Active is about a year, a little over a year in the profit reserve as well.
That's great. Okay, thank you. We're now going to start taking questions from the floor. There's actually a microphone set up at each of the